Welcome back, everyone. Today on the Joseph Carlson Show, Netflix just reported earnings. One of my largest positions in the stock had a rough day. It was down 10% after Netflix was hit with a very unique Brazilian tax law. This was something that cost them over $600 million. We're going to be looking at this and how I view it as a big Netflix investor. And then we have Tesla's earnings report where Elon did the typical. You had the report and the numbers. We'll be going over those. And then we had Elon Musk promises of the future. In this case, it's the Robotaxi network, the rapid, aggressive, sudden, overnight change in it. We also have the humanoid robot army, that this is going to be their biggest product ever. Elon Musk has advertised it as a money-making glitch. An infinite money glitch is the exact words he used. We'll be looking over all of this and diving into Tesla's earnings report and these promises of the future. Because Elon Musk has very ambitious goals to make Tesla the robotics company of the future. But there's one company that I believe is more likely to actually have that robotics future, and that is Amazon. Amazon, on the other hand, is trying to say that they're not a robot company. They're a friendly human company. They don't want anything to do with robots, but the New York Times is stating differently. They've obtained different internal documents from Amazon saying that Amazon has the ambition of replacing 600,000 workers with robots. We'll be looking at this full report, diving into it, and how it matches up with the thesis I gave for Amazon 3 months ago, stating where I believe that Amazon is the best robotics play in the market, even better than Tesla. And then finally, we have the fail of the week, which in this case is multi-millionaire head coaches of the NBA that are risking everything by gambling. We'll be going over that fail of the week as well at the end of this episode. Now, we kick things off today looking at one of my biggest positions, which is Netflix. In the story fund, Netflix is a rather large position. It bounces between Amazon and Google. Right now, I believe that Google, combined with both my portfolios, because this is just one of them, Google combined is the largest position in my portfolio. And that's intentional. I've added so much money to Google, so much net cash added to the company. Plus, it's just done really well. So the combination of those two things is it's now the largest position. Then we have Amazon and Netflix. After yesterday, or after the earnings report, Netflix is down around 11%. So a big hit to Netflix's stock price. My gains fell from around 82,000 to 70,000, but I'm still really well in the green on this one. And when we look at Netflix's earnings report, I want to go through a couple important things. There was one thing that caused Netflix stock to tank 10% immediately after posting earnings. The revenue and the earnings per share both came in. The revenue was 17% growth year over year, which was right in line with analyst estimates. That's what I was expecting. That's what Wall Street was expecting. So the revenue looked really good. 17% growth is healthy growth for a company the size of Netflix. It's growing faster than many companies much smaller. But then you had the earnings per share. The earnings per share came in around 40% below analyst estimates. That was a huge miss, a massive miss. And immediately, within seconds, the bots and algorithms sold down the stock 10%. So what happened? Well, what happened was Netflix announced that the reason they missed on their earnings per share was a $600+ million tax hit that was not in the guidance. It was something they didn't account for. In fact, they didn't even think they were going to have to pay it. But it's specifically a tax from Brazil, a very novel, unique tax. When we look at the overall transcript summary, and this is where Qualtrim uses AI to summarize everything that's in the transcript. First of all, the big thing, the headline news for this earnings report was this tax hit, the Brazilian tax matter. A Brazilian, quote, contribution for intervention in economic domain, gross tax was recognized. Now, you heard that right. This is a tax that's one and alone. It's one that's only in Brazil. It's not found anywhere else in the world. In fact, Netflix management said there's really nothing else like it. They were arguing this in court. They thought that they would win the case. In fact, the lower courts argued in their favor. That's why it wasn't in their guidance. They didn't believe they were going to have to pay this tax. Then they get to the upper courts, and of course, the Brazilian courts may be a bit different than the US. They ruled completely the opposite direction. They said that they do have to pay the tax, and it was a massive tax. It was for multiple years of doing business in Brazil. The gross tax was recognized, impacting operating income this quarter, but most of the expense covers prior periods from 2022 to 2024. So this is like Netflix paying a lot of back taxes all in a single quarter. So any rational, fundamental long-term value investor is going to look at this and conclude that Netflix had a great quarter. They beat on their revenue. They beat on their earnings per share. They beat on their operating margins. Everything looks really good. In fact, all the other business health metrics look better than expected. Netflix views its business as very healthy, with Q3 revenue meeting expectations, engagement hitting record share of TV time in the US and UK. Ad sales had the best quarter ever, with ad revenue on track to more than double in 2025. Progress continued in live events and gaming, including high-profile different boxing matches. They're now making games that you can play as party games on Netflix. The company is only around 7% of the addressable market and 10% of total TV watch time. They say that they're going to grow their market share over time. Netflix emphasized continual improvement in product and content from global perspective. On and on and on. This company is fundamentally in an incredibly strong position. Even when we look at the metrics of the company, just looking at some of the metrics, it is incredible what's going on. $2.66 billion in free cash flow, a 21% increase year over year. Revenue up above 17% year over year. Revenue's growing in every single region in planet Earth. All of this looks very healthy. So as an investor, a long-term investor, you could look at this and say, any rational person will believe that this one-off tax event is not a big deal. In fact, it's something that you don't need to factor into the long-term intrinsic value of the company. But that's not how this market works. The market today is heavily based off momentum. It's based off of whatever stock is on the in right now, moving forward over the next month. As soon as investors see any type of weakness in a stock, whether or not it's intrinsic to the company, whether or not it has to do with its fundamentals, if they see any weakness in price momentum, many investors will bounce and they'll put their money into something else. Now, I've been invested in Netflix long enough to know how this stock behaves, and I've been through many situations where it's down 10% after earnings. This type of situation is literally nothing new. I've been through it so many quarters in the past. And if you're invested in any great company like Netflix, you're going to have volatility in the stock. The most important thing is to pay attention to what's going on with the fundamentals. How is the business evolving over time? What I see continually with this company, and I believe many investors are going to miss out on this, is looking at the forest through the trees. Some investors are going to say, Joseph, it trades at a mid-30s PE ratio. So what? When we look at Netflix, this is a company that has incredible levels of operating leverage, incredible growth path. It is a globally dominant streaming company. It has a more profitable business than any cable television company throughout our history. They can make up for the PE ratio in a very short amount of time. Once we get past this little hit on their earnings per share because of this tax law, Netflix will continue to compound again and again, quarter after quarter. I believe that over time, this is going to be well above $1 trillion market cap. Right now, it's just below $500 billion. I think give it 3 to 5 years, this one's going to be $1 trillion. As far as I'm concerned, this was a fantastic earnings. Now, moving on from Netflix, we get into Tesla, which also just recently reported their earnings. And we can break up Tesla into two different categories. There's the numbers, which not many Tesla investors are really paying attention to because Tesla is all about the story. But we'll look at the numbers anyways for just a minute. We have here the revenue growth of the company, 11.57%. So we can say it grew around 12%. That's growth, and I like seeing that from Tesla. It's not as fast as a Netflix, it's not as fast as a Google, but Tesla's at least growing now. So we do have growth from the company after it being flat for a long period of time. When we look at the deliveries were also good this quarter. They ticked right back up. Hopefully Tesla can continue that without the tax incentives. They worked on a cheaper model vehicle to try to offset the tax incentives going away. So we have here, on a quarterly trailing 12-month basis, their vehicle deliveries are basically flattish. They've trended down a little bit. They're starting to trend back upwards as of last quarter. The net income is not something investors are really paying attention to, but it's down 36%. The free cash flow ticked up this last quarter, so that's up 45%, but it's very sporadic. It's gone around quite a bit over the past year. If we smooth that out, we can look at it on a trailing 12-month basis. This is what it looks like. The trailing 12 months of it are $6.8 billion. Operating margins are at 5.7%. Now, if we looked at any company like this, and you just were to look at the numbers and not know the name of it, if you saw a company growing 12% with 5% operating margins, the earnings per share were flat or down, the total volume of the product they're selling basically flat or down over the past couple of years, you probably wouldn't believe that this stock trades at a 200 plus PE ratio. You probably wouldn't believe that the free cash flow yield is 0.3%, but that's where Tesla trades. It's because of one man. It's because of course, Elon Musk. Elon Musk keeps Tesla stock alive by all the big ambitions and promises of the future. The robotaxi network. He said just a few months ago that by the end of 2025, there'd be thousands of robotaxis driving around without employees in the vehicle. We have yet to see that, but that's one of the things he stated just recently. And in this call, the most recent quarter, he didn't temper expectations. He didn't downplay previous expectations. He ramped it up. He promised a bright new future. And in this case, he promised a future of robotics. Elon Musk calls this new product, which is Optimus, the biggest product of all time.
We're also on the cusp of something really tremendous with Optimus, which I think is likely to be, or has potential to be, the biggest product of all time.
It's likely to be. It has the potential to be the biggest product of all time. So it's a little bit of a teaser there, although he's not giving any guarantees. He says that it's likely. Now that was early on in the earnings call. Around 20 minutes in, he starts ramping up the promises and the bright future. He says that not only it's going to be the biggest product of all time, it is going to be an enormous robot army.
How much voting control I have in Tesla is, if I go ahead and build this enormous robot army, can I just be ousted at some point in the future? That's my biggest concern. That is really the only thing I'm trying to address with this. So it's called compensation, but it's not like I'm going to go spend the money. It's just, if we build this robot army, do I have at least a strong influence?
He tries to assure investors. I don't want more control of the company and more shares in the company because it makes me wealthier. That's not why. It's so that I'll have control of this very powerful, enormous robot army. And I can't trust anyone else, even you, the shareholder, with that additional control. I have to have it all. Now, finally, he refers to this enormous robot army as the infinite money glitch.
Optimus at scale is the infinite money glitch. It's like, it's difficult to express the magnitude of, like, if you've got something if Optimus, I think, could probably achieve 5x the productivity of a person per year because it can operate 24/7. It doesn't even need to charge; it can operate it tethered, so it's plugged in the whole time.
So there you hear it from Elon Musk. He's creating the infinite money glitch. Whether you want to invest in that and bet on him is up to you. But keep in mind that Tesla's already priced as though it does own the infinite money glitch. If we look at this chart here showing the Ford PE ratio of Tesla compared to other Mag 7 companies and then some other car companies, you can see the difference. Tesla's up in the category of 220 plus. Then you have Broadcom at like 40, Microsoft in the mid 30s, Apple 30s or below. Amazon is a fraction of the valuation of Tesla. So if you own Tesla stock today, you're not really concerned about the PE ratio. That's not the first thing on your mind. It's whether or not you believe Elon Musk fully in his ability to create the infinite money glitch, these humanoid robots that take over the world and that he needs to have full control over. Now, I understand if investors believe that, but I have a company that I believe is a much better robotics play than even Tesla, and I've argued this for months. In fact, 3 months ago, I released a video saying that I've invested over $100,000 in this company on the basis that it was not only a great play because of a lot of other reasons, different theses, but there's one additional reason, which is that it's the best robotics play in the market. That company, of course, is Amazon. When we look at my Amazon position, I have $136,000 in it, $40,000 in the green. 3 months ago, I published a paper. In fact, I went over this in an episode called Amazon is the best robotics play. And it went through my entire argument for it, the reasons that I believe that this company is better positioned than even Tesla. At the time, and in fact, I think right now, everyone still believes that Tesla is the robotics company because Elon Musk talks about it incessantly, how they're the robots company. He goes to the biggest microphone he has and talks about that. Amazon doesn't. Amazon likes to pretend like they're not a robotics company. But like Peter Thiel says, the companies that are really monopolies are the ones that try to act like they're not monopolies, like they face lots of competition. The ones that aren't monopolies are the ones trying to convince everyone that they are monopolies. I see a similar dynamic here. Amazon is not trying to tell people that it's a massive robotics play. In fact, they're trying to say just the opposite when they really are. If we look at the reasons why Amazon makes up such a good robotics play, is because they have an incredibly strong in-house engineering and tech talent. They have tens of thousands of engineers, large and fragmented operational complexity, high volume, low margin business model. They have a large labor intensive workforce that can be fully automated with robots, so they can be their first and best customer. They have operations that are not fully optimized for profitability, meaning that their margins can move upwards. They have employee tasks that are routine, repetitive, not creative, deliveries, in-house warehouse logistics. They have financial scale to invest heavily in AI and robotics infrastructure, even more so than Tesla. Amazon is a much more cash generative company than Tesla, so they have far more resources to put into this effort and far lower hanging fruit to benefit directly from it. Now, again, this was a paper that I wrote a few months ago. And then now we get an internal report from the New York Times saying that Amazon is planning on replacing 600,000 warehouse workers or different employees with these robots. And this goes over the ambitions, even more so than just simply replacing employees, but the overall ambitions of Amazon. They say now in interviews and a cache of internal strategy documents viewed by the New York Times reveals that Amazon executives believe the company is on the cusp of its next big workplace shift, replacing more than 500,000 jobs with robots. Amazon's US workforce has more than tripled since 2018 to almost 1.2 million. But Amazon's automation team expects the company can avoid hiring more than 160 people in the United States it would otherwise need by 2027. That would save about 30 cents on each item that Amazon picks, packs, and delivers for customers. Executives told Amazon's board last year that they hoped robotic automation will allow the company to continue to avoid adding to its US workforce in the coming years, even though they expect to sell twice as many products by 2033. This is operating leverage. When your expenses remain flat because of something like robotics, even though your revenue goes up, creating massive margin expansion. That would translate into more than 600,000 people whom Amazon didn't need to hire. So right off the bat, we know that this is a bit misleading of a title. The New York Times makes it seem like they're going to fire 600,000 people, but Amazon's internal document is saying that they're now expecting to not need to hire an additional 600,000 people. So they're basically offsetting or mitigating the amount of people that they'll hire in the future, creating more operating leverage for the business. At facilities designed for super fast deliveries, Amazon is trying to create warehouses that employ few humans at all. The document shows that Amazon's robotic team has an ultimate goal to automate 75% of its operations. Amazon is so convinced the automation future is around the corner that it has started developing plans to mitigate the fallout in communities that may lose jobs. Documents show the company has considered building an image as a good corporate citizen through greater participation in community events such as parades and Toys for Tots. So this is all internally. Amazon isn't going on to earnings call and advertising this. In fact, they're denying all of this. They're saying we're not automating anything. We're not trying to kick people out of their jobs, right? They're the monopoly trying to say they're not a monopoly. They're not trying to convince you, the investor, or the public of this. Just the opposite. But Amazon internally is so convinced that robotics will create so much job loss within the company, that it will automate so many different tasks, that they're going to have to reach out and build a PR campaign around this to avoid public backlash. The documents contemplate avoiding using the terms. So they're not even using terms like automation or AI when discussing robotics. Instead, they're using terms like advanced technology, or replacing the word robot with cobot, which implies collaboration with humans. So they're going way out of their way to even avoid the image of automation. And this is the dichotomy here. Elon Musk is shouting from the rooftops, we're going to automate everything. Our robots are going to be a robot army. We're going to make it so they can do the job of 5 people. Amazon's trying to create code terms to hide their robot ambitions from the public, to hide it from legislators. Because Amazon feels that it's so realistic, it's going to happen, that they're going to have to deal with the public backlash. When I look at these two different situations, I believe more so the company that's trying to restrain themselves to try to hide the PR backlash of their robotics and automation. So we look at this again. Amazon said in a statement that the documents viewed by the Times were incomplete and did not represent the company's overall hiring strategy. Deny, deny, deny. We're not really automating you out of jobs. We're not really trying to make it so humans don't have a place to work. That's just not a complete representation. You're going to be working alongside robots. You're going to have better jobs. We're getting rid of those old, dirty, dangerous jobs. A spokesperson for Amazon said the documents reflect a viewpoint of one group inside the company and noted that Amazon planned to hire more than 250,000 people in the coming holiday season, though the company declined to say how many of those roles would be permanent. And here's one of the most correct takes on this. Nobody else has the same incentives as Amazon to find a way to automate. You can even, again, take Tesla, for example. Tesla has around 30,000 employees. Amazon has 1.2 million. Amazon has far lower hanging fruit to benefit marginally, incremental margin expansion from automation than any other company in the world. The only one that likely comes close is Walmart, but Amazon is far and away the leader in robotics, above Walmart. If their plans work out, quote, one of the biggest employers in the United States will become a net job destroyer, not a net job creator. So Amazon is denying these reports. They're trying to downplay it, but internally we know what's going on. They're trying to automate. They're trying to become more efficient. They're trying to raise margins. If they can accomplish that, the profits would be so immense, it'd make it the most profitable company in the world by far. Amazon makes more revenue than anyone else, the biggest revenue company. It's also growing its revenue in total numbers faster than anyone else. When we look at this company, it's just incredible the potential it has. And when I look again at Amazon and Tesla, the reason that I compare these companies is they're very similar. They're both CapEx heavy companies. They both are a little bit lower margin. They both are plays into robotics. But I've insisted that I believe Amazon is a better robotics play. And just to make this comparison even more full, there's a couple reasons why. Not only does Amazon have the robotics angle, but it also has a much better valuation to begin with. When we look at Tesla, it trades at a 200 plus PE. Amazon is at a 30. So Amazon overall is a much cheaper company. Amazon is also more diversified than Tesla. Tesla has batteries, they have humanoid, they have the robotaxi, but Amazon's revenue is diversified across all different business segments. They have an advertising business, first-party online sales. They have a massive logistics business. They have all these subscriptions and backups. Then, of course, they have AWS, and they're even in the robotaxi business themselves with Zoox. So they're far more heavily diversified. The massive first-party and third-party seller services would get a huge margin expansion if their robotics play plays out. So even holistically, Amazon has a lot more aspects of growth to it than Tesla. It's at a lower valuation than Tesla, and it has a better robotics story than Tesla. I could be wrong on this, obviously, and if you bet against me, if you bet with Tesla, I have no problem with that. I hope you make money. But in this case, this is my bet, and I think Amazon is going to work out well. Now, moving on, we finally get to the fail of the week, which in this case is this shocking report. The head coach of an NBA team, Chauncey Billups, and the Heat guard, Terry Rozier, were both arrested. This is real. They're arrested for different federal crimes, including gambling. Here's a clip of the FBI going over this.
In some instances, players altered their performance or took themselves out of games to make sure that those bets paid out. One example occurred on March 23rd, 2023 in Charlotte. Terry Rozier, an NBA player now with the Miami Heat, but at the time playing for the Hornets, allegedly let others close to him know that he planned to leave the game early with a supposed injury. Using that information, members of the group placed more than $200,000 in wagers on his under statistics. Rozier exited the game after just 9 minutes, and those bets paid out, generating tens of thousands of dollars in profit. The proceeds were later delivered to his home, where the group counted their cash. As the NBA season tips off, his career is already benched, not for injury, but for integrity.
That's a good line by the FBI. His career is benched, but not for injury, but for integrity. Great line there, and great delivery by her. We have Kash Patel, the FBI director, also making announcements going after these people.
Individuals such as Chauncey Billups, Damon Jones, and Terry Rozier were taken into custody today. Former, current NBA players and coaches. What you don't know is that this is an illegal gambling operation and sports rigging operation that spanned the course of years. The FBI led a coordinated takedown across 11 states to arrest over 30 individuals today responsible for this case, which is very much ongoing. Not only did we crack into the fraud that these perpetrators committed on the grand stage of the NBA, but we also entered and executed a system of justice against La Casa Nostra to include the Bonanno, Gambino, Genovese, and Lucchese crime families.
No, that's basically it. These people were arrested. They're under investigation, not officially convicted, but they are under strong investigation. The evidence is overwhelming that they rigged the games and they ran an illegal gambling ring. And the thing that I think is the fail of the week is not just people doing bad things or getting arrested. That happens all the time. But in this case, it's something that is just, it's perplexed me for a long period of time. It's something that I've always been confused by. And that is why do super wealthy people that have already made it, people that are already worth millions of dollars, why do they risk their life and risk their freedom and risk their finances for a little bit more money? That is something I've just never understood. I didn't understand it when I was a little kid. Like, you would hear stories of super wealthy people that are already wealthy. They've already made it, and then they do something illegal and they go to prison. Why would they do that? What is the calculation there? I never understood that risk assessment when I was a little kid. But even as an adult, someone that's seen people through all different wealth levels, I understand. I don't agree with it, and it's morally wrong if someone that's dirt poor and has nothing does something illegal. I understand that. I can at least wrap my head around it. I can get the risk reward calculation. If you're dirt poor, if you have nothing, then the incentive to actually try to do something and risk your life to get ahead is a little bit more, at least it makes more sense. But in this case, when we look at the NBA head coach, Chauncey Billups, just taking a look at his salary, it's $2 million. This is in 2012. Looking at his total payout, his lifetime earnings, it's over $100 million. This guy is beyond wealthy. He is super wealthy. He's in the top 1% of the top 1%. Not quite like billionaire status, but enough to live 100 lifetimes. People are very happy if they get up to $3 to $4 million in their total lifetime earnings. He's made $100 million. What could possibly be the risk reward calculation to risk your life when you're already rich, when you've already made it? I just don't understand it. I don't understand an NBA player. Why would these NBA players that are getting paid millions of dollars, enough to live forever, they could literally live forever with their earnings, just investing it, and they risk that to make a couple $100,000 more? I will never understand that risk reward. It makes no sense. Again, it's still morally wrong, even if you're poor, and I don't think the risk reward is good then. But at least it's a bit more relatable. Like, it's just a bit more conceivable of why somebody would risk something if they grew up dirt poor and they have nothing to their name. I can understand it there. But when you're making $2 million a year, when you're worth $100 million, I don't get it. This is something I just truly don't understand. And for me, it is a big fail of the week. That's going to be it for this episode. Hope you enjoyed. See you in the next one.